identification, assessment, and measurement of risk. That's chapter 15. So we will be studying in detail extensively about risk management, right from the time to understand what is the meaning of risk, the process of managing the risk. There's a concept, there is a framework called as ERM, Enterprise Risk Management. See, that is an elaborated form of what framework yesterday we've learned about internal control. So that one also we will be looking into here as enterprise risk management. Then certain other aspects about risk and models about risk we will be learning. So completely about risk is what we will be looking into post break. Okay. Till when do we have our classes? No, but as soon as we finish the content, we will touch upon certain case studies. So when can I? From Saturday we have 2 sessions. No, I will do case studies also along with the content. I will do case studies also. Okay, go for a break. Join back at 10:30. The next chapter here is identification, assessment, and measurement of risk. So we will be looking into what's the meaning definition of risk. Okay, then how risk is identified, and then assessment of risk. So everything to do with risk, and basically the risk management part of it we will be looking into. How do we define what is risk? Okay, so there's a definition given here. Risk can be defined as an unrealized future loss arising from a present action or inaction. So how do we understand this one? Unrealized future loss arising from a present action or inaction. See, but the future is anticipated, future is expected. So when future is anticipated, um, it's expected that something would happen, but if there is a variation in what would happen, on account of that, the possible loss that can happen, see, it is unrealized. It is only while estimating itself, it is known that there is a possibility of some variation to happen in the future. So this can be defined as an unrealized future loss arising from the present action or inaction. So if they anticipated that there would be some variation, either they take some measure or they do not take measure also. If anything that might happen in the future, so some anticipation about a variation from the expected thing to happen in the future can be referred to as risk. Is defined in many ways. See, this is one way of presenting it here. Some say that it is just that there is some amount of variation from the expected one. Some say that it is a financial loss, it's a monetary loss that happens because of variation. Okay, here it is presented in this particular context, it is presented as it is an unrealized future loss arising from a present action or inaction. Risks are the opportunities and dangers associated with an uncertain future event. So with certainty, it is not possible to expect what would happen in the future, anticipate what would happen very precisely, very surely, with certainty. It cannot be estimated. Future itself is uncertain. So what will happen in the future is not known. So any kind of a plan that is prepared for the future to happen it exactly the same way is not a possibility. So risks are the opportunities and dangers associated with the uncertain future events. Uncertain because So because of this uncertain future events, any variation that happens. What's the problem, Jeremy? Some problem is there? Can be referred to as risk. Okay, risk. We need not always think about risk in a negative sense. Risk is not always a loss. Okay, though some refer to that as a negative impact or some loss to happen. It's not necessary. It is always on the downside. It's not always on the negative side. Let's say that. For example, if they anticipate that in future they would be able to sell some 50,000 units. So this is the expectation. This is the plan. The plan is to sell 50,000 units. But maybe it's because some reason, some events happening of certain events, finally they may end up selling 60,000 units. So that's more. So this is a variation. Anticipation was only 50, but in reality they have ended up doing more business. The demand was more. They ended up selling more number of units. So we see that there is a variation, but this variation is a positive variation. So risk should not always be looked at as an adverse thing. It's not always a negative thing. It could also be positive. The only fact that there is a variation is referred to as risk. With some kind of uncertainty, there's some kind of variation from what is anticipated, from what is expected. That is referred to as risk. So risk could be both downside, both upside, and also upside. So unfavorable or favorable. Okay. Going with the view that risk is uncertain and that there is a negative impact. Should risk be taken up? That's the next question. Why incur risk? Any one of you, do you have an opinion about that? Should risk be taken up or it should be avoided? Okay, I'll put it this way. See, if someone invests in stock market, okay, it is risky. See, general public also, they know, in general it is an opinion that investing in a stock market is risky. So does it mean to say that people should stop investing in stock market? Any investment opportunity which has risk should be completely avoided? Should that be the case? Any one of you investing in stock market? These days students are also very actively trading on the stock market, even if it is in small.
Ma'am, I am interested.
So what attracts you to invest into the stock market? Very good response. What attracted you to take up this? What was the factor which convinced you to take it up?
Yes, ma'am.
What, Jeremy?
Ma'am, the thing that attracted me is the scope of making money.
Scope of making money. Why not some other source? Money is available in many other avenues. I am not recommending, or I'm not opposing that. I'm just wanting to get some information out of that. So you're a student, and you have you're attracted to investing into a into stock market. So into the stocks, you purchase and trade with the stocks, etc. So the answer what you have given is about making money. Okay, money is available in other ways also. Okay, nothing about degrading it. I'm just collecting the opinion. Anyone else? Not, it's not only one student should be answering. Why do you think that people do take up interest investing into stock market? Okay. Easy returns, it is not. I mean, answer is correct. Better returns when returns are there. More money when money can be earned. See, risk is there of losing the money, but when they earn money, better money, the returns are very attractive. Okay, the when there are profits earned, when there are returns earned from that, that's nothing in comparison to I mean, that's far above than any other conventional work which is taken up. See, on an comparative basis, if we can talk about investing in a bank also is an option. Okay, we hardly get any return out of that, because see, that is the way in which the investment into banks are taken up. See, if it is invested into stock market, very soon the returns are earned. But each of them have their own aspect about it. See, investing in a stock market, the interesting factor is about earning easy returns or better returns, what we call it as better returns than compared to investing into a conventional investment opportunity like a bank. But the aspect of it is, the bank, the risk is absolutely not there or almost not there. Um, the investment amount would be safe any day. They can always have back their get back their investment amount. Stock market is not so. When it is affected adversely, when there is a negative impact, there is a risk of even losing the investment amount. Okay, so there we see that there is a relationship between risk and return. If the risk is high, the returns are also high. High risk of even foregoing their investment amount. This is just one example what we have taken. If the risk is high, the return is high. So the possibility of earning better returns is one important reason why people take up risk. Why incur risk is one important reason is risk is directly related to or there is a direct relationship with return. If the risk is high, returns are high. So the motivating factor behind taking up risk is to earn better returns. If the another reason is, if something which has in risk involved, if it is taken up, then that would put them far above their competitors. They can gain a competitive advantage. Until that point of time, what others have not tried, if some business tries that and gets some benefit out of that, that will make them a leader in that particular area, because they are the ones who have taken the initiative. To gain competitive advantage, people get interested or attracted to take risk. So why incur risk? To gain competitive advantage. Okay, so they can be a leader in that particular aspect, um, and enjoy benefits out of that competitive advantage. Second one is to earn better returns, increase financial returns. Okay, that is why risk has to be risk is incurred. What is risk management process? So risk management process, um, if there is risk, say risk Okay. Risk refers to some amount of uncertainty, uncertainty or volatility or variation is in what is anticipated to happen and what would happen. So some amount of variation can be referred to as risk. Then these things have to be managed. So risk management process, a process which manages the risk so that the impact which is there can be minimized. So the process has these steps. First step is risk identification. The second step is risk analysis, analyze the risk. Third one is about risk planning. And the last one is about risk monitoring. Step number one, risk identification. How to identify risk? See, wherever risks are, whenever risks happen or risks occur in the organization, we have something called as a risk register maintained. A risk register will have all the possible risks that can happen in an organization or those risks that can affect the organization. The details of it are recorded in a risk register, so that can be considered as a database related to the risk. So the list of potential risks that are possible to happen. So risk can happen internally. Internally, there could be accounting mistakes, errors, frauds. Internally, there could be embezzlement. Things can be stolen. Intentionally, they can misuse the assets of the organization. See, internally, there can be um, employees not cooperating. So we see that different ways in which the management could be inefficient, not taking appropriate decisions. So these are all possibilities that can happen in the internal environment. Externally, government changes the rules and regulations, non-cooperation from the suppliers, customers expectations change, there are expectations from environmentalists. So many stakeholders are there in the external environment. The investors not extending additional capital, the multiple things that are there. Some of the risks are very specific to the type of industry. Okay, so there is a risk register that is maintained which has all the details about the possible risk that can happen. Of late, we also see that there are certain softwares that are available which give the details about the possible types of risk that can affect a business in a particular industry. So there are certain such kind of databases available from which it can be looked into what are the different types of risks. So first step number one talks about identification of risk. What possible risk can happen that can affect the organization? Risk identification, list of potential risks. After that, see, there are multiple risks. Now these risks have to be managed. So when they have to be managed, there are multiple risks. If there was only one risk focus on concentration would be on that risk, and then it would be managed. But if there are multiple risks, then they have to be prioritized. Which one has to be given importance? Prioritize these risks, and then therefore um, take up that risk and manage that risk. So prioritize the risk and respond to the risk in terms of managing that risk. So the second step is risk analysis, prioritize them and take up the course of action. Next step is risk planning. Okay, risk planning, we will be studying about a framework called as TARA framework, transfer, accept, reduce and avoid. So what should be the strategy when risks are managed? Risks are this planning about risk and then managing the risk. So there is a framework. Little later we will be learning about that framework. So wherever it is needed to avoid, risks are avoided, and some contingency plans should be taken up in place of those events. Okay, so planning for the risk in terms of avoiding or in terms of taking up an alternate course of action. Risk avoidance and contingency plans. Next, we see that risk monitoring, the last step. As they have plans in place to deal with the risk, when that is implemented, so monitor that or assessment of the risk. Okay, these are the stages or steps in the risk management process. Yesterday we did learn about COSO's framework of internal control. So COSO has given another framework called as enterprise risk management. Okay, what is the definition of enterprise risk management? This committee of sponsoring organization, COSO, what we call it as COSO, in 2003 has come out with a concept called as ERM, enterprise risk management. We'll see first what is the definition of ERM, enterprise risk management. It says ERM is a process. Who all are involved in this process? See, enterprise risk management. In terms of managing the risk, there is a concept called as ERM, enterprise risk management. What does it mean by ERM? It says it is a process. In this process, who all are involved? See, the people who are involved are from all levels of management. Affected by an entities, we see board of directors, we see management and other personnel. So from every level of management, people are part of this process. ERM is a process affected by the entities, different levels of management, people from different levels of management. What is that they are all involved in this? See, applied in, they are involved in the areas where they the role of ERM is seen is in strategy setting and across the enterprise, designed to identify potential events. So it's in every area of the organization. ERM would be identifying, this process will be identifying the potential events that can affect the business, that may affect the entity and manage risk to be within its risk appetite. What is appetite? Risk appetite. Within its risk appetite, to provide reasonable assurance that the objectives of the organization would be achieved. Ultimate goal, see, any risk management process, when we talk about, ultimate aim is to ensure that the organizational objectives are achieved. But in between, when we see that organizational objectives are not achieved, in that case, why is that it is not achieved? Because of happening of certain risky events, certain events that can cause risk to the business, it is not possible to achieve the organizational objectives. So therefore, there is a process that is involved in identifying what are the potential risks that can happen, manage them effectively, so that ultimately they would be able to achieve the organizational objective. So this ERM, the concept of it is introduced by COSO. This is a framework which says that it is a process involving people from all levels of management. In terms of see, they would be looking into what is the strategy that is set and in different other areas of the organization. Okay, then they would be, or the process would be looking into identifying the potential risk and the impact that these events can have on the organization, ultimately to ensure that the organizational objectives are achieved. Okay, definition wise it looks so very big, but when we split that, it is not such a difficult thing, it is easy to understand. Now, what are the principles of ERM? Principles of ERM: risk management in the context of business strategy. Risk management, it says that it is everyone's responsibility. That's why we see that people from all levels of management are part of this process. But yeah, the other day also I did mention to you that anything to be effectively implemented, the tone is always set at the top. If there is seriousness with the top management, everything can be effectively implemented. If they are not serious about anything, if um, they are I mean not very particular about implementing things effectively, it cannot be implemented. See, even people at the other levels of management, they are interested, they are serious about it also, it cannot be effectively implemented because the top management are not serious about it. So for everything, anything, we see that the top management has to be serious. The tone is always set at the top. With the tone set from the top, the okay, the in every be I mean here the process in which everyone has to be, people from every level of management would be involved, but the seriousness is always at the top. Okay, then to create a risk aware culture, making them be aware of what are the possible potential risks that can happen, make them aware of that. Then a comprehensive and holistic approach to risk management, consideration of a broad range of risks, that is risk at strategic, financial, operational, and compliance. So looking into a broad range of risks, a focused risk management strategy led by the board. So embedding the risk management, embedment of internal control into the activities of the organization is what we've learned. Now, if there is a risk management in process, that also has to be embedded. It should not be looked into as a separate process, but they have to make it as a part of their activities, organizational activities. So embedding the risk management process into the regular activities of the organization. A focused risk management strategy. So yesterday I did show you one framework for internal control. Yes. How do you know Navin is there in waiting room? That's great. Yes, I do know that. Where are you all? At home or at college? One second, I'm just opening the courses framework. Yesterday I did show you just to draw a similarity between I mean, what is this concept about? See, the COSO has given the framework for internal control. Okay, so internal control framework has 5 components. The first component is control environment. The second one is about the risk assessment, calculation of risk. We have control activities. Then we see information and communication. And then last one is monitoring. Morning also we discussed about these 5 components. Later on, COSO has come out with another framework called as enterprise risk management. So when you see See, when you see that these are the 5 components, to draw similarities, I'm just comparing both of them. See, the 3 major areas where internal control will be applied is, one thing we see, it is about the effectiveness and efficiency of operations, efficiency, effectiveness of operations. Financial reporting will be appropriate without any misleading information, misrepresentation. Financial reporting will be done in a fair manner. Then that they would comply with rules and regulations applicable at all levels of the organization, at the entity level, division level, operating units level, or at the functional level. Okay, I don't have a color image, it's a black and white image. Nevertheless, just look into that. See, we see that now ERM, the operations, reporting, compliance. Along with that, we see even at the strategic level, the planning that happens at the strategic level also. See, we see strategic, operations, reporting, compliance. Even at for internal control also, we did look into that. Across the organization is the same thing. Subsidiary, business entities, division, entity level, everything is the same. Across the organization, this can be implemented. But here, these are not 5 components, these are 8 components. Internal environment, then we see objective setting. Third one is event identification. Fourth one is risk assessment. Then fifth is risk response. We see control activities. 7 is information communication, monitoring. So what is common there and here? We have the control environment, internal environment. That is the same thing. So this is what we have learned in internal control framework. Then from there, we see risk assessment is the same thing. Control activities, information communication, monitoring are the same. See, with respect to risk part of it, instead of having it as one component called as risk assessment, risk is now split into identifying the events which can cause risk. So risky event identification, calculation of risk, just not about calculation of risk, but in terms of risk, what should be the response? What is the response, or what how would these risks be dealt with? So risk response. So risk event identification, risk assessment, and risk response. It's kind of split into 3 parts. Technically, there also, when we study about how to calculate the risk, we did learn about first events are to be identified, and each event, what is the impact that is there. So what is the monetary value of the happening of the event, the impact of these events, which is quantified as monetary loss. So we just have that separated as event identification, risk assessment. One important thing is, apart from that, what would be the response? So after identifying what is the amount of risk, will it be accepted or will it be avoided? So that is the risk response. So we have a framework in terms of risk response, THARA framework. We will see that also. Now, because there is one area which is added, which is strategic. So in terms of strategy, objective setting, objective, what is the objective that has to be achieved, that is also included. So easy to remember about the framework of internal control and the framework of ERM. Framework of internal control has 5 components. Now these 5 components, one, risk assessment, is now looked into from 3 different areas. Event identification, calculation of risk. After calculating the risk, what is the response towards risk? Should it be accepted or should it be avoided? There are 2 other things also. Risk can be transferred or risk can be reduced. So that's why it's THARA. Apart from that, the objectives, it is also into see, where do we see ERM? So the definition says that it is applied in strategy setting also. It is applied in planning. It is applied in setting the objectives so that things can be implemented. So it is applied in strategy setting also. So we see setting the objectives, then the rest of it follows. This framework is applicable across the organization. That is ERM. Okay, to look into each component, first one is understand the internal environment. Once again, I will repeat. Yes, morning also I explained to you about that. But what are these components? One last time we'll look into that. First, understand the internal environment. What is the organization size structure? Then the board of directors. Then their roles and responsibilities. Then if there is system which is there to control the risk, then what are the policies and procedures? Those things have to be communicated to people in the organization. The attitude of the top management, the abilities of the employees in the organization, the role of board of directors, audit committee, and others in the organization in terms of managing the risk. So first, thoroughly understand about what is the internal environment. After that, what are the objectives? Objective setting. The objectives that have set, see how our objectives set. Class number one, first class we've learned about the process, strategic process. Objectives are set based on different types of analysis, internal, external, stakeholder, etc. So what is that has to be achieved, has to be decided, that is decided as objectives. Objective setting. Then comes event identification. What are the events that can cause risk to the business? How do we identify? I did mention to you about a risk register in which all possible risks that are possible to be to happen are recorded. The details about those events are recorded, and that can be referred to for reference. Or there are certain softwares available which can talk about the possible events that can happen, which can cause risk. So events have to be identified. Events can happen internally, externally. After events are identified, then assessment of the risk. Assessment of the risk is calculated. So how is risk calculated? So the quantification of risk, the risk is equal to, there are two things which are to be looked into. The impact. What is this impact? Impact which these events have on the organization. So the happening of the event itself is not risk, but the event, what impact it has on the organization should be quantified. And impact, and the second variable is the likeliness of such a thing happening also has to be taken. The percentage chance of the happening of this event, we call this to be as probability, that also should be taken up. Okay, impact into probability. Okay, multiply them and calculate the risk. That is risk assessment. After the risk is quantified, after the risk is calculated, next we see what is the response. So response is, we know that it is risky. There are four different responses that can be seen in case of risk. One is the risk can be avoided. Maybe see, basically the response is in terms of um, the attitude of the individual or the organization. So what is their attitude? Do they want to take up risk? If they want to take up risk, why take up risk? Just now, few minutes back we've discussed. Why take up risk is maybe to increase the financial returns and have a competitive advantage. So they can come forward, take up the risk, accept risk. Or if they are averse to risk, they don't like to take up risk, so they just want to be there in the market, survive in the market, not experiment many things, not think about maximizing the profit, but they want to have their presence felt in the market. If they can make a decent amount of return, they are happy. That's an attitude. Okay, so if that is what is their attitude, they can also think about avoiding the risk. Okay, One is accept, one is avoid. Next is maybe risk is present there. They do want to take it up, but they do not want to take it up as it is, but take all possible measures to reduce the impact of these events. So risk is reduced. That's another response. Risk reduction is the third response. One more response we have it as, see, if there is a risk that is present, do take it up, but need not face the consequences of the risk. That can be transferred to a third party. But who would be taking it up? So transferring is that if you identify that there is a risk present, that risk is insured. When it is insured, there is an insurance coverage for that. Take it up. If it is going to affect the organization, see, then we decide on when to adopt any of these four strategies. Also, there is something there. We will be looking into that. Then, if risk is present, the attitude can also be in terms of transferring the risk to a third party. But then again, it cannot be anybody cannot, but those that have this coverage of insurance by paying a premium, that is what has to be done so that the risk can be transferred. So the framework is called as TARA framework: transfer, accept, reduce, avoid. Okay, so that is the risk response. Then next one, sixth one is control activities. Ensure that there are proper control measures taken in terms of restricting the access for various things, or having segregation of duties, ensuring that the assets are safeguarded, etc. So some certain kinds of control activities should be taken up. Okay. Then gather all information relevant to the risk, how risk can be effectively managed. Gather all information and communicate that to the people in the organization as they implement the risk management process. Constantly keep monitoring about how things are implemented. Okay, so that's the concept of ERM. I hope I made it clear. What are the benefits of having effective ERM? Benefits of ERM: enhanced decision making by integrating risk, what are the benefits of effective ERM? The first one says that enhanced decision making by integrating risk, the resultant improvement in investor confidence, focus of management attention on the most significant risk, common language for risk management which is understood throughout the organization, and reduced cost of finance. First thing, if at all, if there is a risk management process in place, risk management, see, um, so there is a process in place which looks into managing the risk. So if at all, if there is a risk actually happening, because there is preparedness already, they are aware of what are the possible events that can cause risk and how to manage them. If there is a strategy in place, then they would be left with fewer surprises. They would not be surprised if something happens negatively, positively. If there is some amount of variation, there is some amount of risk that occurs, there would be preparedness. Okay, so the decisions that are taken, enhanced decision making by integrating risk. They know about it, they understand that, because the risk management process should not be looked at as a separate process, but it has to be embedded into the system. So they know, they are aware of what would happen and what is the consequence and how to face that. So that preparedness would be there. Feeling surprised would not be there. Um, Getting impacted by the risk would not be there, but better management would be there, enhanced decision making. Then if there is a risk management in process, the investors will have their confidence because they know that yes, there is a risk management process in place. Even if they are hit by any negative events also, they still know how to manage with that. Why? Because there is already a process in place. Therefore investors confidence will improve. They can focus of management attention on the most significant risks. The risks are prioritized. When there are multiple risks that are happening, the how to deal with these risks, the way in which these risks would be dealt is by prioritizing them. Prioritize the risks. The most um, um, impact, the events that have most impact or the risks that have most impact are dealt first in the order of priority. Risks are taken up for managing them. Okay. Then everybody understands what is risk management process. So it's a common language of risk management which is understood throughout the organization. Last point, I want one of you to somebody to throw light on this. Reduced cost of finance. From where are we talking about cost of finance? Reduced cost of finance through effective management of risk. See, to have a risk management process, it involves costs, isn't it? A new system to introduce, it involves cost. So what is that we are talking about basically? Reduced cost of finance. I want somebody to respond. Whatever you feel like you can share. No, nothing as such as to what is the right thing, what is the wrong thing. Why would there be reduced? In fact, actually, to have a new process to bring about and then introduce and embedding it into the system, etc., all that in fact requires additional cost. But what are we talking about? Uh, Reduced costs, and this time it is reduced cost of finance. Um, Optimum rate at which the finance can be borrowed. But how are we connecting it to ERM? The cost of finance, the rate at which they can borrow the finances is one thing. But why would someone extend them funds at a reduced rate? Why would it happen in connection to ERM or in connection to risk management process? The reason is we already have discussed about the improved investors' confidence into this. So therefore, there is an assurance among the investors that risks are effectively dealt. Therefore, they are confident about the organization managing the risk. So there is no uncertainty which can be seen. So they are assured of earning a return on that. In terms of shareholders, the shareholders get attracted based on the profitability, so they come forward and invest in the company. So when the when they exhibit the confidence, then I think their expectations from the company will not increase. If their expectations to earn higher returns will not be there. They know for sure that yes, there are better ways to manage the risk. So they do not put pressure on the company to earn better returns and pay better dividends. So that's one thing. See, like one of the students have mentioned that reduced cost of finance. The investors know that yes, their returns are sure, so they have their confidence, so they extend their funds or investment at lower cost of capital. So expectations from the company in terms of better returns will come down. So when that comes down, higher expectation comes down, then automatically the cost of finance also reduces. This is possible because there is a risk management process in place. When there is a risk management process in place, the see wherever risk is high, the shareholders expect a higher return. That is called as implicit cost. What they want a return is an explicit cost. What they expect the company. See, now satisfying the shareholders is very important for the company. If they are not satisfied, they would withdraw their investment. That will have a negative impact. So to satisfy the shareholders is one of the objectives of the financial management. Now, when the shareholders are confident that risk is effectively managed, then they do not expect a higher return. If they have a higher expectation, to fulfill that higher expectation and paying better dividends is the only way what the company has, that will increase their cost of capital. If it is not so, if the expectation of the shareholders is not very high, then then those things would not be taken up, and the cost of capital will be under control. Reduced cost of finance through effective management of risk. I hope I made it clear. Okay. In fact, actually, different category classifications of risk we can see, but whatever comes our way, we will take it up, because the paper is not only about risk management. Risk management is one part of SBL. So whatever is given according to our syllabus, whatever comes our way, we will take it up. But these are not the only types of classification of risk. There are various other ways of classifying various categories of risk which are there. But whatever is there in our syllabus which comes across our way, we will take it up. The paper is not about risk management. One section of strategic business leader is risk management. Why are you to study this one? Tomorrow, when you become a leader in an organization, you should also have a knowledge about how to manage the risk. Therefore, you study. That's why see, the paper has diversified topics, many things. Okay, um, but every topic touches the aspect of decision making. You, as a leader, have to have this information, this knowledge. You should be equipped with this knowledge so that you can become a good manager. You will be able to take better decisions. How to know that? If you pass in the examination, whatever is expected of you to present that in the examination, if you do that, you yourself will prove your worth, and then you will become a leader. May all of you become good leaders by clearing this exam, and then join the organization with required skills and ability to take better decisions. Next, come to strategic and operational risk. One category of risk is risks are categorized as strategic risk, operational risk. Strategic is strategic. See, class number one, first class onwards, we've been studying about the strategy. Strategic risk is the planning at the organization level. The plan that is applicable for the entire organization, strategic planning. So strategic risk. So if there is a risk connected to strategy, strategy is a plan for the organization. Strategic risk is the risk that the strategy of the organization or the plan of the organization will fail. That is the risk. When there is planning that happens, um, which which involves the entire organization. So that's called a strategic plan. The the concept of strategic risk is risk that the plan will not do well. Risk which is at a see, it is just not at the organization level, it could be also at the global level. Okay, so it affects the overall mission of the organization. Why is the overall mission of the organization? Because plan which is prepared to ensure that the objective, the mission can be achieved. If there is a possibility of that plan not doing well, that will be about failure of the plan, failure of the plan, not making it possible for the mission to be achieved. That is called as strategic risk. Risk that the strategy of the organization will fail, not allowing the mission of the organization to be achieved, or the objectives of the organization to be achieved, can be referred to as strategic risk. Operational is at the implementation level. Risk that will affect the day-to-day planning, affects the day-to-day activities of the company, is referred to as operational risk. Okay. Strategic risk arising from the possible consequences of strategic decision taken by the organization. Why would it fail? Why would it fail? There are many factors about why would it fail. It could be internal, external, all those things. Possible consequences of strategic decisions taken by the organization also arise from the way an organization is strategically positioned within its environment. So it's just not about inefficiency of implementing that. Sometimes external factors, even at the global level, also we can see that sometimes certain factors do affect the organization, not enabling them to achieve their um, or achieve their objectives, not able to implement their strategic plans effectively. The failure can be from internal inefficiency of the management to implement it effectively, or there are factors in the external environment that can affect the organization, because of which the um, things do not happen, um, and then the objectives of the organization cannot be achieved. Also arise from the way that an organization is strategically positioned within its environment. Then we see that should be identified and assessed at senior management and board of directors, because see, the strategic planning, who's involved in the strategic planning? The management at the top management, the senior management, top management, board of directors, they are all involved in strategic planning. So it should be identified and assessed by them, people at the top. What analysis are useful in identifying this is pestle analysis, in the external environment, the political, economic, social, technological, environmental, and legal factors, how these uh, how these factors can affect the organization. Pestle analysis, SWOT analysis, both internal as well as external. So take up these analysis to understand about what are the strategic risks that are present, how they can affect the organization. Next one, operational risk. Operational is the implementation, so day-to-day happenings of the organization. They refer to potential losses that might arise in business operations, include risk of fraud or employee malfeasance, poor quality production, or lack of inputs for production, can be managed by internal control system. So at the time of implementation, so internally, then we see that it could be about risk of fraud or employee being involved in some kind of embezzlement or fraudulent behavior, stealing things. So employees misbehavior. Um, So risk of fraud or employee malfeasance or poor quality production, too many defective units are produced, or lack of inputs for production. So these are internal factors which can affect. So day-to-day implementation, if there is any failure which is seen, is called as operational risk. Then different categories of risk. Conceptually, you should be knowing about what are these risks. Okay. Conceptually, the risks that are present, let's learn them. Shall I give you an assignment here? Very simple. These are the different types of risk. Um, how many are there? 1, 2, 3, 4, 5, 6, 7, 8, 9. 9 students. Each one of you learn one thing, and then you just give 1 minute or half a minute explanation about what is each type of risk. Voluntary, there are 100 odd students. 9 topics are there. So I think each one of you can come out with 1 point. Half a minute also, if you talk about, that's more than enough, because these are conceptual knowledge. If you have, that's sufficient. So you don't even have to open the textbook, hard copy, soft copy. Anything you type it in Google also, market risk, it will give at least 1 line information, minimum 1 line information. So at least you will get that. So talk about that for half a minute tomorrow's class. We're going to wind it up in another, how many more classes? I don't know. Max, it will be 3 to 4 days. We will wind it up. So please take it up and then talk about it. Will you? Will you? Anyone? What are the different types of risk? Or should I explain that? That at least you tell me. Should I be doing that, or will you take it up? Small assignment only, no? No response at all. Okay. Mm. Having done so much, why should I leave even one slide? So let me explain. Risk is because of some uncertainty happening. See, there are different categories of risk. The first one talks about what is market risk. Market risk is the risk that there would be failure in the market. They would not be able to do well in the market, maybe because they do not perform well because they cannot meet the customers expectation, or there is a failure in the market, is referred to as market risk. So in connection to market risk, we also see that why would there be a failure in the market? Maybe because their products and services are not doing well. So sometimes product risk is also referred to as market risk, because they're not performing well in the market, because the products and services fail in the market. We can refer that to be as market risk, or very specifically we can talk about it as um, product risk separately. The products are not doing well, therefore it is not doing well. So um, then because of uh, dealing with the products, there are price fluctuations, therefore they are not able to do well in the market. Anything to connect to those aspects about, because of the price fluctuations, because the market, they are not doing well. Sometimes some factors affect the um, business drastically, that their products are not sold. Sometimes certain rumors are spread out in the market about the quality of the product, etc. Few years back, around about 4 or 5 years back, there was a some information passed on in the market that um, you also must be remembering. I do not know whether you remember it or not. See, it was an information which was passed on stating that in when Maggi noodles were tested in the lab, they did not match the required standards. There was some harmful ingredient included into that. Therefore, it is not safe for um, the health of the children. So that was some information that was passed on. So that affected the reputation of the company. So it was a situation where people started dumping the products also, that which was purchased also, people started dumping that in the market. It was a chaos, complete chaos. It was on the verge of uh, the brand exiting from the Indian market. It's not only it's not about across the world, but it's only in Indian market. That's one example. Sometimes maybe it is genuine, maybe it is not genuine. For some companies, the reputation of the products and services also do get affected, and then that will cause them not to do well in the market. Their products and services automatically fail. So anything that happens in the market, if they are not performing well in the market with respect to the products and services, because of their quality, because of they do not meet the customers expectations, because of the reputation getting affected, um, for all these reasons, then we see that um, there is risk present in the market. Okay, so that's market risk. Legal risk. The legal risk is self-explanatory. Legal, because of changes in the rules and regulations. If there is any amount of risk that is present, is called as legal risk. So why would there be changes? Because of change in government, change in political scenario. Uh, the when governments change, when there is a change in the political framework, see, across the globe in different economies, we see that different things keep happening because of political instability, unrest, new governments taking charge. Then they come out with new rules and regulations. They do not want to follow what the previous government has decided. So such kind of things will cause change in the legal framework, the rules, the regulations. Okay. If those things happen, then there is a legal risk. Okay. Any changes in the economy on account of political, legal factors, if there is any impact on the organization, we call them as legal risk. Credit risk is credit risk that um, see, credit is a concept where to attract the customers, the credit facility is extended to the customers. Goods are sold to the customers on credit basis. They are supposed to pay the amount promptly on the due date. But if they fail to make the payment on the due date, it will be referred to as bad debts. We know that. Okay, that is the risk. The risk that the customers fail to make the payment is called as credit risk. Okay. Reputation, I already explained to you what is reputation risk. The reputation of the business, when it is affected, it will have an impact on the transactions of the business. Many stakeholders will not come forward to be associated with the organization, and that will result in the failure of the company. It is just not about the customers. Sometimes we also see that the other stakeholders, like the investors, the credit, the investors, the creditors, the suppliers, they do not like to be associated with the company because of the reputation that gets affected. So any risk that is faced because of the reputation getting affected is called as reputation risk. Liquidity. The concept of liquidity is about um, converting their assets, current assets, into cash. That's the concept of liquidity. um, See, there is investment made into fixed assets, investment made into liquid assets. So um, When investment is made into current assets, the purpose behind that is these current assets are easily converted into cash, and with the cash they are able to meet their um, dues or current liabilities or on the due date, and run the business. They can also support their working capital. That is the intention behind investing it into current assets. Now, if these current assets are not converted into cash, if there is a difficulty in converting them into cash, then in that case, they will not be able to meet the current liabilities. They will not be able to make the payment for their operating expenses. See, if the liabilities or the creditors are not paid their dues on the due date, what affects is the reputation gets affected. See, then in future the supplier will change the terms and conditions. Maybe discounts will not be given. Maybe the supplier will stop extending any credit period to the credit facility to purchase that. See, these are aspects which we see in connection to liquidity. If they cannot convert their current assets into cash to make the payment of the creditors and meet the operating expenses, and then in that case, any amount of risk that is faced by the business is referred to as liquidity risk. Business probity. Probity is the concept of probity is about the truthfulness, honesty. Okay. Um, See, if we are talking about the honesty part of it, the truthfulness, it is referring to the ethical aspects of the business probity. The risk about their honesty, their fairness, their truthfulness. See, if it is connected to that, if it is connected to the ethical values of the business, and if it is felt that they are not ethically sound, if the organization is not ethically sound, they are not honest with certain aspects of it, if that has an impact on the business, that can be referred to as business probity. Health and safety or environmental risk. See, wherever it is environmental issues, there are certain things to be complied. There are certain rules and regulations which are laid out for the organizations which have to be followed. So when we talk about environmental aspects, uh, um, the generally in case of environmental aspects, there are certain rules and regulations which there are certain specifications that are mentioned to be followed. Okay, if they do not follow, okay, if they do not follow these measures, then in that case they can attract fines and penalties and fines and other things. See, anything to do with environmental, see, um, there are different types of cost in case of environmental aspects. So the conventional cost of utilizing the resources, etc. Then if at all if they do not take proper measures, then that can have an impact on the um, health of the people in the organization, because of the pollution that is emitted, that can affect the health of the people in that economy. If that is the case, then that will have an impact on the reputation of the organization. If the reputation gets affected, then they can lose on the customers. The customers stop purchasing goods from them. See, lost sales is one thing. Then see, they are supposed to comply with the rules and regulations to reduce the impact that is there. If they fail to comply with the rules and regulations, the one impact is that they can lose on the customers and the sales. That is one risk. They can also have the risk of being penalized for not following the measures appropriately. Then they can be penalized with the tax, with fines, etc. So anything to do with the environmental health, safety measures that have to be followed, any risk that arises can be referred to as health and safety or environmental risk. Uh, Next one is derivatives. I'm assuming that you know about what are derivatives. So if you don't know, also I will not be telling you now what is derivative. Um, See, derivative is it is a um, when it's a financial instrument when dealing with the losses, um, to minimize on the losses that can happen when they enter into agreements to minimize the losses. So they deal with derivatives. So on account of dealing with derivatives or using the or being involved in the use of financial instruments, if at all if there is any amount of risk that is present with, because they are dealing with derivatives, is referred to as risk on account of derivatives. Then we see technological risk because of changes in technology. See, whatever investment they have made into technology then can become outdated. So all that will become a loss. So technological risk is because of changes in the technology. Whatever was invested already, if it becomes outdated, freshly they will again have to invest into technology once again. So that would be referred to as technological risk. All of them have, you have to have the conceptual knowledge. Will the question be on any one of them, or will there be a direct question? No, you won't get direct questions, but there is an expectation that the person who's writing this examination has a thorough knowledge about different aspects of it. This is one topic, and under risk is categories of risk is one thing. Let's see, the case study is dealing with risk management. One section of the case study is dealing with risk management. So the question can be identify what are the possible risks that can affect that particular company, the company which is there in that scenario. If you are not aware conceptually what are the different risks, will you be able to identify what risk can affect that organization? So you will not be able to identify it because you do not know what are the different types of risks. If you are aware of that, then immediately you will be able to connect to that. So theoretical answer, it is a general answer about what are the different types of risks. See, if you read that, if you have a knowledge about that, you know what are these concepts about that, you will be very quickly able to connect it, relate it to that particular company in the case study, and then give out your opinion about what are the risks that can affect the business and what measures should be taken to deal with that risk, mitigate the risk. So that is how your approach would be there in the examination. Another category is about sector specific risk, business risks that are generic, that will affect all the businesses. Okay. um, there are risks that affect only specific business industries. So let's say that in a particular type of industry there is a material that is used. So if there is non-availability of that material, only one industry, one type of industry and the businesses in that industry only will get affected. Specific. So some risk can affect the all the businesses. Tax rate change in the tax rate can affect all the businesses across the economy. So those are called as generic risk. Specific to a specific type of business or industry, we call them as specific risk. Risk assessment. I did mention to you about how risk is measured. Calculation, assessment of risk is, I will explain this as the last topic. from risk mapping, we will take it up in tomorrow's class. How is risk calculated? First, events are identified. Event identification is one thing. Identify the events that happen internally, externally. Make a list of it. The happening of the event is not risk, but the event when it has an impact on the business, which is quantified. Take that impact. The events have an impact on the business, quantify them and find out what is the consequence of the event, consequence of happening of the event, that is taken as impact of the risk of on the organization. Monetary value, this is one variable. It is multiplied into the likeliness of such an event happening, the likelihood of the risk actually occurring. We identify maybe 10 items are identified, but what is the chance that it would happen exactly? See, we are in rainy season. Morning news says that it would rain during the day. So if it would rain during the day, does it mean to say that 100% it will happen that day? What's the chance of rain happening? It is a rainy season, it is a rainy day, but after sometimes it can, the sky can become clear. It may not rain. So what is the chance that it will rain? Is there a 80% chance, 100% chance? Does it have a 20% chance? So what's the chance or what is the probability that it will happen? Mere listing out the events is not sufficient. Event and the impact it has on the organization. So after that, e- what chance does it have? The multiple events, each of the event which is identified, the chance of the probability of happening of the event also has to be identified. So event number one, what's the monetary loss? What's the chance of it to happen? Event number two, what's the consequence? What is the probability? Event number three. Likewise, all the events and the impact these events have on the organization, take them with respect to each event. What is the probability? Identify that, multiply the impact into the probability. The sum total of all the events impact into its respective probability will be risk. Okay, so that's how risk is calculated. Okay, that will be the last topic today. So tomorrow we will continue with the other topics. Any doubts? Any area? Any doubts? Okay, then let's wind it up. If you don't have any doubts, okay, I'll meet you tomorrow.